What's up, guys? Welcome to my YouTube channel. It's Natasha Barella, the Money Nista, 20 years in audit, accounting, and tax, 13 in the large business and international division of the Internal Revenue Service. So I want to talk about items that are highly audited. And if you've been following me, you know there are some deductions that I don't care for. They're more feel-good deductions than they are really effective. People like to argue, you're entitled to it, you take it, that's great, you can. That doesn't mean you should. Okay? Not everything is worth it. Some things just don't have a high impact. I go for high impact items. I don't go for low impact items. And so let's just run through a couple of items I've noted that, are audit triggers, right? If you run a cash heavy business, what's a cash heavy business? Things like a beauty salon, right? A laundromat, okay? Restaurants, convenience stores, anything cash heavy can trigger an audit, okay? And I have been known to see examiners in a certain division audit cash heavy businesses and estimate their sales, okay? Because some things don't ring the sound of truth, right? And there's no way to really track cash sales. Okay. IRS doesn't like that. So if you can, and you're running a business based off of cash, I would say try to get a payment processor. It just makes life easier. Okay. Accept credit cards, accept debit cards, whatever have you. You just don't want an exam. Once your return is picked up for an exam, the examiner can pick up your prior year and your subsequent year. A lot of times, many of you don't even know your return from the prior year and subsequent years being looked at. Many of you don't even know your return was looked at and thrown back and not audited, right? The more transparent you are in your return, and to my business owners, I teach this in the Tax Strategies Mastermind. The more transparent you are, the less likely you are to receive that letter, right? Because what happens is your return is selected for whatever reason. Okay. And it goes through a series of review, right? A series of levels of review. And by the time it gets to you, many people have reviewed it. And even then your return is reviewed by the examiner, and the examiner a lot of the times may tell the manager, hey, listen, this is not really worth the time. They've looked at your statements. Your statements are very, very transparent. They give so much detail that they know that you're going to have a lot of detail, right? People who give detail have a lot of detail and have a lot of receipts. So I'm very, very prudent on using your credit card statements to match your invoices and your receipts. And, I teach my students to download, their credit card statement every month, because you should be keeping your business expenses on one credit card per business, per EIN. Okay. And adding a note section, right? Download it. All credit card companies have the ability for the most part to download in Excel. You download it in Excel, you sort it, you add by each type of expense, right? So you can keep track. And even if you add a column and say, hey, this was for, an agreement between you and XYZ company, right? You had to pay a retainer fee to a lawyer, for organizational costs or whatever have you. Always keep some notes in one of the columns. Okay. The second one is filing a Schedule C. It's not against the law to file a Schedule C. Many people start off as a Schedule C sole proprietor, right? Single member LLCs, you are a sole proprietor for tax purposes, okay? Your LLC is a business designation, but for tax purposes, you're a disregarded entity, so you're going on a Schedule C. Why are Schedule Cs targeted? Because it is easier to snag a small business owner in any kind of error or deduction that they shouldn't have taken, right? Because a lot of times you don't have good counsel, you don't seek good counsel, you can't afford an accountant or a tax advisor. So you try to do things on the fly, or you get someone that is just a preparer and not necessarily a tax specialist, and all they do is data entry. Okay. And they know that you guys, Schedule C people, my sole proprietors, my small businesses are trying to pull as many deductions as possible, and they're not always applicable. Okay. The next one is my least favorite, and that is the home office deduction. I am not saying not to take it. I am saying sometimes it's not worth it. So I'll calculate my home office deduction every year. I prepare my own taxes. And if the return is not significantly great, I just remove it because it's just not worth it. It is a highly audited item. It's not worth it. It's not worth the aggravation. Again, once your return is picked up for an exam, your prior year and your subsequent year is picked up, and all the unnecessary digging is done. Even if you're legitimate, it's just an emotional nightmare for small businesses because they can't afford to hire somebody to represent them like a large business could, right? So there are things that I tell people, if it doesn't really give you a huge impact, it's not worth it. And a lot of times, to be honest, I want to say maybe 80 to 85% of the time, the home office deduction really does nothing. Okay. So, and let's talk about another one. People who consistently have a loss. If you have a loss for 5, 6, 7 years, you could be deemed as a hobby. Okay. You have to prove intent to make profit. Now, I know we just came out of COVID-19. Are we still in COVID? I don't know. So there's going to be a lot of losses, but it has to make sense, right? There's a story behind every tax return, and you have to be able to justify those losses, right? Things that were likely to have huge losses, particularly in 2020 to 2022, are restaurants, right? You know, hospitality, anything that was impacted by COVID-19, anything that required human contact like that, right? So it's foreseeable that they had a significant amount of losses, right? Everybody had losses. We were all impacted in some way or other. People lose their jobs. They can't pay for services. Service providers don't have a lot of income as a result. So there are things that can make sense for losses. And then there are times where your losses just don't make sense, right? And so if you have 5, 6, 7 years of losses and there's no real justification, you'll be deemed as a hobby and not a business, okay? And we're going to talk about the one that I'm always harping on everybody about, which is mixing your business and personal expenses. Never, never, never. So you will get a lot of memes, a lot of Instagram videos, whatever have you, selling you, you know, a lot of ways to take deductions and try and get over. The fact of the matter is, when you're just starting out as a small business, let business be business and let personal be personal. Okay. Let business be business. If it's a business trip, let it be a business trip. Have an agenda, have a conference room booking. You got to have proof, right? It has to make sense for your business. If it's a vacation, let it be a vacation. Okay. When you get to the point where you're, you know, large enough where you can justify business meetings while on vacation and kind of combine the two, great. But just don't do it when you're still in the growing phases and the expansion phases, right? Again, think like this. If you can't afford a $500 an hour tax attorney or more, don't do it. Okay. Just don't. Don't try to sneak by. Do people get away with it? Absolutely. Every return in the United States doesn't get audited. But in the off chance or on chance that you do get examined, you're in the system. Okay. And then lastly, which is which is a lot of people's kryptonite, is using your car for business. A lot of you want to purchase a car, write off the cost of the car. We have bonus depreciation, section 179, right? If you don't have another car for personal use, it's going to be very difficult to justify a business vehicle. A lot of people do it. People get away with it. People don't get away with it. It's just a matter of when it's your time to get caught. Your business also has to make sense for a vehicle, right? It has to make sense. Right. If you're in real estate, it makes sense. You need a vehicle, right? If you're in a business that doesn't make sense for a vehicle, I wouldn't do it, right? I don't sell the purchasing a car dream because I know what it's like being on the side of an exam, you know, as an examiner, and I know what it's like to be on the side of the examined, right? Because I can, you know, tell you about the experiences of the people I examined. If you're not in large business, right? If you're not considered a large business, which is over 10 million or more in gross receipts and our assets, you're going to be highly targeted for these things. Highly targeted because it's likely that the average person does mix some business with pleasure, right? Some business with personal, rather. Okay, it's highly likely that a lot of people try to get away with it. So I'm just here to tell you, you know, be careful of the deduction dreams people sell you. Okay. A lot of it doesn't work in real life. It doesn't translate in real life. Don't buy something and then see if you can deduct it for business. Be in business first, then buy it. Okay. Be a legitimate business first and then buy, put the cash outlay for the expense. Okay. Let's not try and buy a new car just to say you can expense it. That's not how that works. A lot of people will give you these ideas and these dreams and not give you any context. You're not likely to get away with it. You cannot have no profit in your business and deduct a car. Okay. You have to be making money, and it has to make sense for your business. It has to tell the story. It has to ring the bell of truth. All right. So that's another tip from your truly the Moneyista. Thank you for joining. Hit the subscribe button, and I will drop the link to join my free live training and or the tax strategies mastermind in the description box. Have a good one.